Like I promised in the last video, I'll show you my bullish step-by-step trading process on copper futures. If you watched my previous videos, you know that I always start my trading process by trying to determine the higher time frame directional bias. I use my bullish conditions to determine where price is likely to trade to next and or where is the market likely drawing to. Here is my step-by-step process of determining if higher time frame directional bias is bullish. I start the process with picking a market that I'm looking to trade. In this example, I chose to trade high-grade copper futures contract. I always take my short-term trade on the contract with the highest volume and or highest open interest. In this case, that was copper's March futures contract. After I pick the market, I refer to its seasonal tendency. Here we can see copper's futures seasonal tendencies. As we can see, copper in fact has bullish seasonal tendency in the beginning of the year. The bullish seasonal tendency starts at the beginning of January, and copper futures usually really climb higher in February. As soon as we spot the bullish seasonal tendency, we proceed to the top-down analysis. We always start our top-down analysis on the monthly chart, and then repeat the same process on the weekly, daily, and 4-hour charts. I always start with noting the present trading range and asking myself where have we recently traded from. After that, I proceed to the most important part of the top-down analysis, that is determining institutional order flow. If down close candles are supporting price and or large candles form with up closes and or price has recently reacted bullishly on a discount array, for example, price has a sharp rejection after trading below an old low, institutional order flow is bullish. In practice, this looks like this. I did top-down analysis on copper's March futures contract on 21st of January. As you can see, I made less changes to this file on 22nd of January. For that reason, we will first look at my analysis from 21st of January. And after that, I'll show you charts from 23rd of February to see if our higher time frame directional bias actually materialized in price action. Thanks to seasonal tendencies, we know that copper is historically bullish in January and February. To further increase our odds, we determine if institutional order flow is also bullish. We use top-down analysis to determine if institutional order flow is in fact bullish, and we always start our top-down analysis with the monthly chart. Whenever I look at the chart, I immediately refer to the down close candles and inefficiencies. Are they supporting price? In this case, we see that they in fact are supporting price time and time again. I also look if price is unwilling to go lower after trading below a short-term low. I want to see price rejecting old lows and form large up-close candles. We see that this is also true. That means that monthly institutional order flow is bullish. Here's a close-up of the current monthly trading range. We see that price is in discount of the trading range. Price traded below a short-term monthly low and immediately rallied. Again, indicating that institutional order flow is bullish and that higher prices are in order. After monthly institutional order flow is determined, we carry monthly PD arrays to the weekly chart and continue our analysis here. Our objective is to again determine if institutional order flow is bullish. We see that price trades below the old weekly low and immediately rallies higher, taking out a weekly short-term high, creating a shift in market structure. Weekly candles close with large up closes and fair value gap forms, indicating that institutional order flow on the weekly chart is bullish. After determining the weekly order flow, we carry our weekly PD arrays to the daily chart, and we repeat the process there. On the daily chart, price consolidates above the old monthly and weekly low. Price then drops lower to take out the sell-side liquidity pool, and immediately rallies higher after that. This is a classic bullish breaker pattern, which provides the stage for bullish opportunities. Monthly, weekly and daily institutional order flow is in sync, meaning we have a high probability bullish conditions. Before we proceed to the pattern recognition stage of my trading process, I recommend that we look if price was in fact bullish for the rest of January and February. This is the monthly chart on 23rd of February. We see that price did in fact trade higher and took out the monthly short-term high. Here we can see that January closed with a large up-close candle that was followed by a bullish February candle that took out the monthly buy-side liquidity pool and retraced from the candle's high after that. Here is the weekly chart. We see that price retraces into the weekly fair value gap and explodes higher after that. Notice how the retracement happens with small down close candles, and then price displaces out of the fair value gap with the large up close candles. This is the power of trading with the higher time frame institutional order flow. Price also traded into the weekly inversion fair value gap, as well as the consequent encroachment of the weekly wick. Here we can see a weekly PD raise on the daily time frame. Here we can see my bullish pattern number 3. Price trades higher from the breaker. We can also see that there is a daily fair value gap inside the breaker, which puts the odds of success even more in our favor. And here we can also see the daily balanced price range, which gave us the narrative that price will in fact not trade below the breaker, and that we are ready for higher prices. Here I want to note that we do not need to catch the lowest daily low. We can be patient and wait for the candle to close. And that provides us with the highest probability that price is ready to expand higher to our predetermined targets, inefficiencies and/or old daily, weekly and/or monthly highs. In this case, the above bullish conditions are in fact true, but if the above bullish conditions were not true or were not clear, the higher time frame would have been neutral. In that case, I would wait for either opposing bearish conditions to be true or for above bullish conditions to form. In other words, if institutional order flow is not absolutely clear, I do not do anything. Once institutional order flow is determined, I refer to the Commitment of Traders report. As I have mentioned at the beginning of the video, I did my higher time frame analysis on 21st of January. So here we can see the COT report from 21st of January. Commercials are in a net short position, but if we look at the commercials hedging program, we can see that they are in fact bullish, which further increases our odds of success. On 7th of February, commercial hedgers were still bullish. And on 21st of February, we can see that they took some profits and are now around the 50% line. Because commercial hedgers are in a long position, we can now look for intermarket relationships to confirm our long trade idea. I start with referring to the dollar index. Because the price of copper is in dollars, it will be much easier and quicker for copper to rally if dollar index is falling. On the left chart, we can see the dollar index is in fact bearish. To be more precise, we see that on the 3rd of February, dollar index created a large rejection, indicating that lower prices are in order, just as copper took out a daily short-term low and closed higher, indicating that second bullish impulse leg is about to materialize in price. Because copper falls into the precious metals category, I look at gold, silver and platinum to confirm my trade idea. We can see that gold is also bullish in this time period, and we can see that SMT formed between gold and copper, further confirming that higher prices are in order. We see the same thing on silver. Order flow is bullish and there is also SMT between copper and silver. Platinum is also bullish. We can see that copper is the only one making a lower low, meaning that it accumulated sell stops under the old daily low, and it is now ready to rally higher. Intermarket analysis support our long trade idea. We can proceed to the pattern recognition stage of my trading process. I have three precise ways of identifying support and resistance patterns, and until at least one of the bullish patterns materializes in price action, I do not do anything. Here are the three bullish patterns. First is the internal range liquidity. Second is the external range liquidity. And third is the bullish breaker that I can use to either pyramid my position, or if I miss the turtle soup entry, I can enter it here. Each pattern is unique, but they are actually all connected to one another. In other words, when price trades below the old low in pattern number 1, that becomes the turtle soup, or my bullish pattern number 2, where I can now look for a trade setup on a lower time frame. And if I miss the entry on the turtle soup, or I want to pyramid my position, I can wait for the bullish breaker. And once I get a bullish breaker, there is usually a lower time frame optimal trade entry that overlaps with that breaker. And I can repeat the described process if I want to further refine my entry point. As long as I get the higher time frame direction right, these patterns provide me the lowest risk trades with the highest probability of success. Once I determine my higher time frame directional bias, I look for my bullish patterns on 4-hour and or 1-hour charts. Here we can see my bullish pattern number 1 on the 4-hour time frame. Price trades lower below an old low into the 4-hour bullish order block, closing in the 4-hour fair value gap, as well as trading into the optimal trade entry levels. For additional confidences, there is the 4-hour inversion fair value gap, as well as the new week opening gap. Here's the same pattern just on the 1-hour chart. Here we can clearly see the sell side liquidity pool, as well as the 1-hour inversion fair value gap. Here's the close up of my bullish pattern number 1 on the 1-hour chart. We have identified one of my bullish patterns. As soon as we see either one of the patterns in price, we continue to the execution stage of my trading process. Here's the detailed step-by-step process that I follow for my executions. At this stage, I determine my entry point, I define my risk, and where I will take profits. I can take my trade on the 4-hour and or 1-hour chart. In this case, I will place my limit order at the 4-hour order block, which is just above the 0.618 level, and my stop loss would go under the impulse swing low. This is a conservative stop loss. Here's where I will take profits. Because we are trading in the direction of the monthly, weekly, and daily institutional order flow, I would look to take my profits at higher time frame inefficiencies and or higher time frame old highs. I always split my positions into thirds or quarters and scale out as the market moves in my favor. In this case, I would take my first partial profit at the first daily short-term high, which would be my external range liquidity exit on the daily time frame. Second partial would be at the weekly internal range liquidity, short-term high. That would give me a risk-to-reward ratio of 5.11, and my final exit point would be at the old monthly high for the risk-to-reward of 12.65. If I want to refine my entry points and minimize my risk, I use 4-hour and or 1-hour entry levels as a place to look for the lower time frame pattern to execute on. I look for my lower time frame bullish patterns on 30, 15, 5 and or 1 minute charts. Here we can see the 1-hour chart pattern. Price trades below the old low and into the 4-hour bullish order block. When that happens, I drop down into the lower time frame charts and look for the same three bullish patterns there. Here we have the 15-minute chart. We can see the turtle soup, or where smart money accumulated their longs. It is not necessary that we enter our trade there. We can identify the breaker and wait for price to trade above that level and enter our position there. Here's the 5-minute chart. We can see that the breaker is also overlapping with the 5-minute inverse fair value gap, which puts the odds of success further in our favor. We already have our entry levels, but to nail down our stop loss levels, we need to look into the 1-minute chart. First, we see that we indeed get our turtle soup entry, once price trades into the sell side liquidity pool. I look for the market to displace above the short-term high, and after that retrace back into the fair value gap that was created as the market displaced above the short-term high. I would enter it there and would put the stop loss below the impulse swing low. Another entry would be at the breaker that we have identified on the 15-minute chart. We know that there will usually be a lower timeframe optimal trade entry that overlaps with the bullish breaker. I use that pattern to identify my stop loss placement. As you can see, you trade the bullish breaker, but you also trade the lower timeframe bullish pattern number 1, which overlaps with the breaker. In this case, I will split my positions into quarters. I'll take my first profit at the initial high of the day. That would yield me a 8.38 risk to reward on the turtle soup entry and a 5.91 risk to reward on my breaker entry. My second partial would be at the daily high. That would give me around 18 risk to reward ratio on both trades. I would take my third partial profit at the weekly internal range liquidity. That would yield me around 28 risk to reward, and my final exit would be just below the monthly short-term high. That would give me a risk to reward of 69.08 on the turtle soup entry and 77.64 on the breaker entry. After I enter my trades, the trade either works or it doesn't. In any case, I go on to the next trade, and I repeat the described trading process. I know that individual trade outcomes are independent and random, but over a series of trades, they produce consistent results. That is why I always trade in sample sizes of 20 trades or more. That way, I make sure that I am thinking in probabilities and judge the viability of my edge based on the results of at least the next 20 valid trades or more. In other words, I determine my success on the results of my valid sample size, rather than on a trade-by-trade basis. In the next video, we will study my bearish step-by-step trading process on the Australian dollar. Please don't forget to like, comment and subscribe so you don't miss our next upload.